Hey everybody, it's Mike from Orderflows here, and welcome back to my channel. I'm glad you could join me for today's video, where I'm going to be talking about an order flow trading strategy called stopping volume. And it's more than just reading what's taking place in the order flow. I'm also going to talk about what is a good chart type to use, and the answer is probably going to surprise you. But before I jump in, if you've been enjoying my videos, be sure to subscribe to the channel, click the notification bell so you don't miss any new uploads that I make. And if you find this video helpful, be sure to hit the like button for me and leave a comment sharing your biggest takeaway. I love hearing your feedback. All right, so let's go and talk about today's subject. Now, a question that I get a lot is, well, it's really two parts. What is the best market to trade, and what is the best chart type to trade? Really, you could choose there's so many different futures markets out there. There's about 40, 50 in the US that, trade decent enough volume that you can trade. And to be honest, you can trade, even once you get a bit of experience, you could trade some of the more, I don't want to say illiquid markets, because, markets like some of the agriculturals, there is decent volume that you can trade. And then, it sort of splinters off into the next question. Well, what's the best chart type? Because, in the past, I used to use a lot of range-based charts, and now I use a lot of time-based charts. That doesn't mean one is better than the other. As a trader, you evolve. You want to put the order flow in a format that is easy for you to make sense of what you're looking at, right? There's no point of looking at the order flow on a chart that you're going to struggle with, right? So that's why sometimes I talk about range-based charts, sometimes I talk about time-based charts, even tick-based and volume-based charts, but really the main charts you're going to want to use is most likely going to be time-based charts or range-based charts. And now that's not to say you can't use a Renko chart. Again, it's all about putting the order flow, right? The data that you're getting from the market, from the exchange, into an easy to read format, okay? And, the strategy I'm going to talk about today is called stopping volume, right? And really, what is stopping volume? It's just heavy volume coming in at the end of a move, either a move up or a move down. Basically, stopping the market from dropping any further, right? It hits its floor. There's a big bid down there. There's passive buyers waiting there. Or if it was a move up, be big sellers up near a high. And today in the E-minis, there's a great example of this. And let's just go back to it here. Okay, so it came in around 10 this morning. All right, let me get the crosshairs up here for you. All right, and you can see this is a 1 minute chart, okay? And it's coming in at 50.92 and a half. And what is stopping volume? Okay, well, the first time we trade here in this bar at 10:14, 11 contracts trade. Okay, we bounce up a tick. Next bar opens up, comes down. So basically, it's trading 2.5, 2 3/4, 2 3/4 offered at double O or 93 even. And there's a big bidder down here. How do I know it's a bidder? Well, by looking at the volume, I see it's coming in on the bid side. So I know you have aggressive sellers selling into that. So it's actually, 11 plus 997, that's what, 1,018 contracts there. So basically just over 1,000 contracts. Now, how do I know this is stopping volume? Well, one, I understand this market. I know what heavy volume is, especially on a minute-based chart. I can see, 997, just, again, you don't have to sit here and make notes and say, is this heavy or not? And right, I could just look at the recent trading that's going on. I don't see anything really that strong. Here's 700, here's 800, or I think earlier we had 905 here. So 900, close to 1,000, is pretty strong. Okay, market in this bar started to rally up. We did hit 900 here. Then it went offered there, right? You can see the 539 traded there, okay? Stopping volume stops a move, basically, okay? That's what you got to think of when you think of stopping volume. Now, how can you tell really easily? Where's the point of control in the bar? Okay, well, normally, point of control in the bar is going to be somewhere in the middle, right? When you think of, the standard deviation of how volume is distributed throughout the bar, it's going to be somewhere in the middle because you've had plenty of time to trade in each bar. And you'll notice, most of the bars, it's somewhere near the middle, okay? But when I have a green bar and I have the volume, the heaviest volume, meaning the point of control, at the bottom of the bar and the market reverses, to me that's a clear sign of stopping volume. And you see the market got a nice rally off of this. And again, it comes down to understanding 997 at the end of the move is a strong sign of stopping volume. Now, this is a minute-based chart, and sort of getting back to the other chart types, right? Because you could also use, a time-based. This is a time-based chart. You could use a tick-based chart. So let me just grab one here for you. Just give me a second. Whoops. There we go. I had to move my recorder. You can see down here, right? Now this is a range-based chart, so it's based on price movement. And right down here, let me get the crosshairs up on here. You see 1,008. Okay, so my math was off. I thought it was 1018. Anyway, you can see down here, 1,008. Markets reversed. Now the point of control is not on the bottom of this bar. It's actually here because you got 466 and 593. You add those two numbers. It's bigger than just 1008. But usually when you see stopping volume, right, it's going to be all on one side at the bottom of the bar. 1,008 right here, and it's going to come after a move. Here, 8. Is that a stopping volume? No. People say, what about this? 102? No, it's not at the end of the move. This is the move, right? We just sold off. That was at 1014, 1015, 950. We were trading 51.12 and 3/4. We sell off 20 points, and boom, it stops. That is what stopping volume is. And again, stopping volume is not something you see happen left and right in the market, right? It's understanding it's above average volume going through at the end of the move, right? Because normally what happens is you get to ends of moves and, volume just sort of peters out. But there was still some strong selling. You can see we're coming into this low, and we're coming in pretty hot. A lot of selling imbalances. That's those red numbers in the footprint. Even here, this bar's got 1, 2, 3, 4, 5, 6 selling imbalances, followed by another 1, 2, 3. So there is strong selling. You see the deltas, 907, 300, but then it just ends right here because you have strong passive buyers basically absorbing whatever aggressive selling is taking place. Now again, getting back to the chart types, it doesn't matter if you're using a minute-based chart or a range-based chart. What matters is that you're able to take that information that the market is generating, traders are generating in the market with their buying and selling, and putting it into an easy-to-read format. Okay, so if I was looking at a time-based chart, I could have picked it up, but it was a little bit easier to see it on a range-based chart. Okay, because on the time-based chart, it's kind of split out, in this case, over 2 bars, 1 and 2. Whereas on the range-based chart, it's just on the 1 bar. Okay, but again, you still see that 997, the point of control on the bottom of the bar, that stands out as well. And what was interesting on the time-based chart, which you don't see on the range-based chart, you have this one big bar here, strong negative delta, 1140. But on the range-based chart, we're coming in. You see, you got that nice, we hit that low, and then we start rallying. As you're coming in, you're kind of coming in hot. Minus 907 delta, minus 304, minus 162. So it was coming in strong, then weaker here, right? Because look here on this big selling, it's all minus 1100, minus 900, minus 200, minus 800, minus 700. Then delta's kind of mixed, and then the delta picks up again, minus 900. And you're thinking, oh my God, am I going to see a repeat of what I just saw here with the strong selling? It's 304. Okay, it's not light by any means. Then you hit minus 162, so you should already be thinking by looking at this, if you're looking at a range-based chart, minus 907, minus 304, minus 162, then it actually turns positive here, 399. Okay, aggressive selling, less aggressive selling, lesser aggressive selling, aggressive buying. All right, that you can see on the range-based chart, that on the time-based chart, you just don't see it there. Now you do have, you can see the aggressive buying picking up here. So you had the strong negative delta, minus 1140, then a positive delta, 221. Not overly strong, it's decent. and then it grows a bit more, 343, 359. So it's getting a little bit stronger over subsequent bars, right? Especially after you had that big aggressive selling taking place here, right? And that would have me worried. You got very strong selling and we can't go any lower. Just as, over here, you had very strong aggressive selling, minus 1400 delta. Here, minus 1496. This one just went sideways. This one continued right in the next bar. So if anything, you get this strong negative delta, then you're just sort of going sideways. Maybe there's going to be some more aggressive selling coming in. Here, this bar had minus 554, but it couldn't go any lower, and we just started rallying up from there. But you saw some signs here early of some aggressive buying coming in. So what you're looking at actually between the two different charts, you can see here the aggressive selling just sort of getting weaker than the aggressive buying coming in. But if you're looking at a time-based chart, you don't notice that the aggressive selling is getting weaker. All you see is this one bar with strong negative delta. And then you start to see the aggressive buying creep in here, okay? So again, there's different ways to look at the market. If you're looking at a time-based chart, you notice one thing, right, with the aggressive buying coming in. If you're looking at a range-based chart, you're noticing that aggressive selling is coming in. Now, ideally, it'd be great if you could, if there was one chart that would show both of those things, but, the charts are created differently based off of different methods of plotting data, right? Time-based charts, it just goes by time, right? After, this is a minute-based chart. After 60 seconds, boom, a new bar is going to form. Whereas range-based, deals with price movements, right? It doesn't take into account time. It doesn't take into account volume. It takes into account how price is moving, okay, to form new bars. So there's no right or wrong chart type. I know guys that use Renko charts. I don't personally, but they're successful with it. So who am I to say, no, you can't use that? If you have a chart that you use that helps you understand the market that you're looking at, by all means, use it. All right, everyone, that's going to end this video. Again, if you haven't already, be sure to hit the subscribe button. I like to get this channel growing and keep going from there. So have a great rest of your day, everyone. Take care.